Hi everyone, I am Dr.R. Devi Prasanna, Assistant Professor, School of Management, Kristu Jayanti College, Bengaluru. In this video lecture, we are going to learn ratio analysis. We are going to learn what is ratio analysis, advantages of ratio analysis, limitations of ratio analysis, and types of ratios. The learning outcomes of ratio analysis are understanding financial performance, comparative analysis, trend analysis, decision making, financial statement interpretation, performance metrics, limitations, and awareness. What is ratio analysis? Ratio analysis turns financial accounts into easy to understand numbers. You can compare firm to firm, division to division, or year to year. We usually look at the income statement and balance sheet to extract the figures. Stakeholders can draw conclusion about the company's performance. Thus, ratio analysis is one of the techniques of financial analysis to evaluate the financial condition and performance of a business concern. Simply, ratio means the comparison of one figure to other relevant figure or figures, or financial ratio is the expression of the relationship between the financial figures. According to Shim and Giol, ratio analysis is a financial statement analysis technique that uses ratios to evaluate the performance and financial health of a company. There are three different forms in which ratio can be expressed. They are pure ratio, percentage, and rate. When the ratio is expressed in the form of simple division of one number by another number, it is called as pure ratio. For example, we can calculate current ratio by using pure ratio. The ratio can be expressed in the form of percentage. For example, net profit ratio, gross profit ratio, operating profit ratio, etc. The ratio can be expressed in the form of rates, that is number of times over a period of time. For example, stock turnover ratio, debtors turnover ratio can be calculated using rate. Advantages of ratio analysis. Performance evaluation. It helps in assessing the overall performance of the business over time and against industry benchmarks. Financial health assessment. It identifies the strength and weakness of a business, aiding in financial planning and decision making. Comparative analysis facilitates comparison between companies within the same industry or with the industry averages. Investment decision. It helps the investors in making informed decisions regarding stock purchases or investments. We'll see who are the users of ratio analysis. Ratios have a great significance for different kinds of people. They are investors, managers, creditors, government, employees, general public. Limitations of ratio analysis. Historical data dependence. Ratios are based on past financial statements, which may not accurately predict the future performance, ignores qualitative factors. Ratio analysis focuses solely on quantitative data and overlooks qualitative aspects like management effectiveness or market conditions. Variation in accounting practices. Difference in accounting methods can distort comparison between companies. Potential misrepresentation. Ratios can be misleading if not analyzed in the context or if key financial figures are manipulated. Window dressing. To show better financial position than actually it is resulting, the ratio analysis may be misleading. Classification of ratios. We can classify ratios into four broad categories: liquidity ratio, profitability ratio, activity ratio, solvency ratio. Liquidity ratio, we have current ratio, quick ratio, cash ratio. Under profitability ratio, we have gross profit ratio, net profit ratio, operating ratio, return on assets ratio, return on equity ratio, earnings per share. Under activity ratio, we have stock turnover ratio, assets turnover ratio, debtors turnover ratio, creditors turnover ratio. Under solvency ratio, we have debt equity ratio, proprietary ratio, total asset to debt ratio, interest coverage ratio. Before looking into the formulas, we'll see what are current assets and current liabilities. Current assets include cash in hand, cash at bank, sundry debtors, bills receivable, marketable securities or short-term securities, and other short-term investments and inventories. Current liabilities includes sundry creditors, bills payable, outstanding and accrued expenses, income tax payable, short-term advances, unpaid or unclaimed dividend, bank overdraft, etc. Liquidity ratios. Under liquidity ratio, we have current ratio, quick ratio, and cash ratio. Current ratio measures a company's ability to pay its short-term obligations using its current assets. Current ratio can be calculated dividing current assets by current liabilities. Quick ratio. It is similar to current ratio but excludes inventory, focusing on more liquid assets. Quick ratio can be calculated by dividing quick assets by current liabilities. Quick asset is nothing but current assets minus inventory and prepaid expenses if any. Cash ratio. It measures cash and cash equivalents. It can be calculated by dividing cash and cash equivalents by current liabilities. Profitability ratios. Profitability ratio can help answer questions like, is the business making profit or is it growing? How efficient is the business at turning revenues into profit? Is the profit enough to finance reinvestment? Is it sustainable? How does it compare to the rest of the industry? Under profitability ratio, we have gross profit margin. It indicates the percentage of revenue remaining after deducting the cost of goods sold. It can be calculated dividing gross profit by revenue into 100. Net profit margin. It reveals the percentage of revenue remaining after all expenses are deducted. It can be calculated by dividing net income by revenue into 100. Operating ratio. It measures the operational efficiency by comparing operating expenses to net sales. It can be calculated dividing operating expenses by net sales into 100. Return on assets measures how efficiently a company uses its assets to generate profits. It can be calculated by dividing net income by total assets into 100. Return on equity shows how much profit a company generates for each rupee of shareholders' equity. It can be calculated dividing net income by shareholders' equity into 100. Earnings per share. This indicates earnings allocated to each share of stock. It can be calculated by the formula net income minus dividend on preference stock divided by average outstanding shares. Activity ratios. It is otherwise called as efficiency ratio or turnover ratios. Under turnover ratios, we have inventory turnover ratio, asset turnover ratio, debtors turnover ratio, and creditors turnover ratio. Inventory turnover ratio. It measures how quickly a company sells its inventory. It can be calculated by the formula cost of goods sold divided by average inventory. Asset turnover ratio. It measures how efficiently a company uses its asset to generate revenue. It can be calculated by dividing net sales by total assets. Debtors turnover ratio. It measures how effectively a company collects receivables from customers. It can be calculated dividing net credit sales by average debtors. Creditors turnover ratio. It measures how quickly a company pays off its suppliers. Creditors turnover ratio can be calculated by dividing net credit purchases by average creditors. Solvency ratio. Under solvency ratio, we have debt equity ratio. It indicates the proportion of debt financing relative to equity financing. Debt ratio can be calculated by dividing total debt by total assets. Proprietary ratio. It measures the proportion of the owner's equity to total sales. It indicates the financial stability and capital structure of a business. It can be calculated dividing owner's equity by total assets. Total assets to debt ratio. This ratio measures how many assets a company has relative to its total debt. It is a measure of solvency indicating the company's ability to cover its debts with its assets. It can be calculated by dividing total assets by total debt. Interest coverage ratio. This ratio measures how easily a company can pay interest on its outstanding debt with its operating income. It reflects the company's ability to manage its interest expenses. It can be calculated by dividing EBIT by interest expenses. To conclude, ratio analysis is not just about numbers. It's about understanding trends and making informed decisions. Comparing ratios over time or against industry benchmarks provides actionable insight for stakeholders, helping them strategize and allocate resources effectively. Ratio analysis is a critical tool for analyzing or assessing a company's financial performance and overall health. It provides insights into various aspects of the business, including profitability, efficiency, liquidity, and solvency. Thus, financial ratios are a powerful tool for understanding a company's financial performance. Thanks for watching the video.